Hello everyone and welcome back to Stock Navigators Option Series Chapter 2. In this video I will talk about the delta and gamma, two of the Greeks associated with options, and we will talk about their properties, their mechanics, and why you should care about the delta and the gamma when you trade options. So let's get into it. So first of all, let's talk about the Greeks. So what are the Greeks? The Greeks are metrics to quantify the sensitivity of option prices to changes in underlying market conditions. The Greeks are a very effective risk management tools and especially helpful for understanding and managing the risk of your positions. As the market condition changes, the Greeks will change as well. Four of the most important Greeks in trading options are delta, gamma, theta, and vega. So in this video, we will focus on the delta and the gamma only, and the theta and vega will be for another day. So what is delta? The delta describes the sensitivity or the rate of change of an option's price with respect to the change in the underlying price. The delta represents an equivalent amount of the underlying stock at the given moment in time in percentage. The thing about delta is that it does not remain constant because as the market change, the stock price change, the delta will change as well. So the delta is not a fixed number. They will change with respect to stock price change and the market conditions. So the calls will have a positive delta and the puts will have negative delta. A trader can use delta to hedge their long position for their portfolio, and we will talk about that in another video where I will show you how you can buy put and look at the what they call the zero delta or net delta play to protect your portfolio. Delta also represent the probability or chance of winning in terms of percentage. So what does that mean? So on the chart, I have the option table for ticker SNO. Let's say we're looking at the option expiring in December 10th, which is next week. So if you look at the delta of the $350 strike price, it has a delta of 0.46. So what does that mean? That means if the price of ticker SNO increased by $1, the price of the $350 call will also increase by $1 of the underlying stock multiplied by 0.46 delta. So that is 46 cents. So meaning for every $1 move to the upside of ticker SNO, your call, your buy call at $350 strike price will increase 46 cents. So similarly for the put. So let's say if you think that the market will go down and you purchase a put option for SNO, then the delta for $350 strike price put is negative 0.54. So that means for every $1 move to the downside of this ticker SNO, the $350 put will gain 54 cents. So the delta also represents the chance of winning or the probability when you trade options. If you look at the gray box on the right hand, on the very right column of my option table, you will see a gray zone. So the gray zone is the predicted move. So meaning my option table in TradeStation has some mathematical model integrated in it. Also, they have the same function in Thinkorswim as well if you are a Thinkorswim user. But essentially, this represents the probability where the price could potentially move by the end of next week. So let's say if we look at option expiry on December 10th, 2021. So the predicted move for ticker SNO is ranging from $312 up to $380. However, if you go bullish on SNO and you purchase the $315 call, the premium is higher, but your delta is higher as well. The delta for the $315 call is 0.82, meaning you have a 82% chance of winning, meaning by Friday or by December 10th, the price of snow will most likely stay above the $315 strike. So that is a high probability strike. However, if you don't want to spend too much premium, you can purchase the at the money strike or the $350 strike with the delta of 0.46, and that means you have about a 46% chance of winning. So this is a medium probability strike. Finally, if you strongly believe that snow can potentially go up to 375, you can purchase this out of money strike at 375. However, the delta for this strike is only 0.2, meaning for every 1 point move to the upside, this strike only make 20 cents per $1 move, and therefore the chance of winning is only 20%, and that is a very low probability strike. So when you trade option, these are the key thing about delta that you have to understand, because when you purchase out of money options, it's cheaper, but at the same time you have a lower chance of winning or a lower chance of breaking even. So the next Greek that we're going to look at is gamma. So what is gamma? Gamma is the sensitivity or the rate of change of an option delta with respect to the change of the underlying price. So meaning when the delta change, that change is happened because of gamma. So the gamma is an additional factor that will affect the change of delta as well. So gamma is expressed in terms of the change in delta produced by 1 point move in the underlying stock. The gamma simply increases or decreases the delta of the option as the underlying price changes. For example, let's say if I purchase a NEO at $51 call, and it has a delta of 0.49 and a gamma of 0.06. So when the price of NEO goes up by $1, the new delta of the $51 call is going to be 0.49, which is the current delta, plus 0.06, which is the associated gamma. So the new delta for this move is going to be 0.55. And similarly, if I purchase a $51 put on NEO, has a delta of negative 0.51 and a gamma of 0.06. So when the price of NEO goes down by $1, the new delta for my $51 put is going to be 0.51 plus 0.6 is going to be 0.7 to the downside. So we can look at this option table, and again, if you look at the calls columns, let's say the strike at a $50 strike price, they were at the money with the delta of, let's say, 0.49, but the moment NEO go up and the $50 strike becomes in the money. So if you add 0.49 to the 0.06 gamma, that will give you a new delta of 0.55. And similarly for the put, so the put for the $52 strike price was increased from negative 0.51 to negative 0.56 because it is added up with the gamma on the column next to it. So the gamma of an option is not linear, and this is also sensitive to the market conditions. The gamma is highly dependent on the location of the strike price relative to the underlying price. Sometimes it's called the moneyness and the time left until expiration. So meaning the gamma, as we approach or as the option approach the expiration date, the gamma will start increase exponentially. And the gamma is highest when an option is at the money. And the rate of change of gamma itself will increase as the expiration approaches. So on this graph, as you can tell, if you look at the black and the gray curve, which represent 60 days until expiration and the 90 days until expiration, you can tell the slope of these curves are very gradual, meaning the gamma is very subtle, it's very slow. But if you look at, let's say, the top one, the dark green, the solid green curve, which is the gamma 5 days before expiration, as you can tell, is going in the bell curve. It's kind of a parabolic shape, and that is because by expiration, any movement of the option would make a big difference. So let's say if you purchase a $150 strike and the stock price closed at $150.25, and therefore your option is in the money and you can exercise your option. So the gamma is always more volatile during the expiration week. So for example, if we are comparing between the two expiration date of ticker Tesla, the top one is options expire on December 10th, and the table below are the option expire on December 31st, which is 4 weeks from now. As you can tell, if you look at the money strike at $1,015, the delta is about the same, 0.52 and 0.54, but the gamma for December 10th is higher than the gamma for December 31st. So that means when you purchase short-term options, the change in price of your option is more sensitive to the underlying stock price because of the gamma. So as the stock price move up, your delta will increase or decrease faster than the long-term options. So let's sum things up. The delta is the rate of change of your options value with respect to stock price, and delta also represent the probability of winning, meaning the more in the money the strikes are, the higher probability of winning that option strike will have. And the gamma represents the rate of change of delta with respect to stock price. And the short-term options will always have higher gamma than the long-term options. And gamma is highest when approaching the expiration date. So this is the end of this episode. I hope you enjoyed this. I hope you will learn something from your option trading when you look at gamma and your delta. So if you like this video, please give us a like, subscribe, and you will get notified when we post new lessons. Thank you for watching.